Tonight, we are going to explore a system that is often overlooked, yet quietly shapes every part of the hidden ways money really works. Money moves through the world in ways that remain largely invisible. Each day, transactions occur, payments are made, value transfers from one place to another. Yet the underlying system that allows this movement operates quietly beneath the surface of everyday awareness. Most people interact with money through simple actions. A card is swiped, a number appears on a screen, a balance changes. These moments feel immediate and direct, but they rest upon layers of structure that extend far beyond what is visible in that instant. The financial system is not a single entity. It is a network of relationships, agreements, and mechanisms that together create the possibility of exchange. This network connects individuals to institutions, institutions to other institutions, and economies to one another. The connections are often invisible, yet they shape what is possible. When someone holds currency, they are holding a representation of value. That representation is accepted because of shared understanding, shared trust, and shared infrastructure. Without the system beneath it, the representation would have no meaning. The system gives it context, stability, and function. The complexity of this system is not immediately apparent. On the surface, transactions appear simple. Value is exchanged for goods or services. One account decreases while another increases. But beneath this simplicity lies a vast architecture of processes, safeguards, and coordinations that make each transaction possible. This architecture was not designed all at once. It developed over time, shaped by needs, problems, and solutions that emerged gradually. Each component was added to address a specific challenge. Each connection was formed to enable a particular kind of exchange. The result is a system that functions continuously, adjusting and adapting as circumstances require. Money itself is a tool for coordination. It allows people who do not know each other to exchange value. It allows value to be stored and transferred across time. It allows effort expended in one moment to be preserved and used in another. These functions depend entirely on the system that surrounds money, giving it meaning and utility. The system operates through rules, conventions, and technologies. Some of these are formal and written. Others are informal and understood. Together, they create a framework within which money can move reliably and predictably. This framework is maintained by institutions, guided by policies, and sustained by the continuous participation of millions of actors. Understanding this system requires looking beneath the surface of transaction. It requires recognizing that each moment of exchange is supported by processes that are not visible, but are always present. These processes ensure that value can be measured, recorded, transferred, and preserved. They create the foundation upon which economic activity rests. The invisible nature of the system does not diminish its importance. In fact, the more seamlessly it operates, the less visible it becomes. The goal of the system is not to be noticed, but to enable. It exists to make exchange possible, to reduce friction, and to create trust where it might not otherwise exist. Tonight, we will explore this system slowly and calmly. We will examine how it is structured, how it functions, and how it maintains stability. We will look at the components that make it work and the relationships that hold it together. The journey will be gradual, allowing each concept to settle before moving to the next. The financial system is the infrastructure that enables money to function. It is a collection of institutions, technologies, and agreements that together make it possible for value to be stored, measured, and exchanged. Without this infrastructure, money would be unable to serve its purpose. At its core, the financial system exists to solve a fundamental problem. Human societies require a way to coordinate economic activity. People need to exchange goods and services, save for the future, and transfer value across distances. Direct barter is limited and inefficient. The financial system provides an alternative, allowing these exchanges to occur smoothly and reliably. Money is the primary tool within this system, but it is not the system itself. Money is a medium of exchange, a unit of account, and a store of value. These three functions are what make money useful. But for money to perform these functions, it requires support from the broader financial infrastructure. As a medium of exchange, money allows people to trade without needing a direct match of wants. Someone selling a service does not need to find someone who has exactly what they need and also wants that service. Instead, they receive money, which can then be used to obtain other goods or services. This simple mechanism dramatically increases the efficiency of exchange. As a unit of account, money provides a common measure of value. Without such a measure, comparing the worth of different goods and services would be extraordinarily difficult. Money allows prices to be set, compared, and understood. It creates a shared language for economic value. As a store of value, money allows effort and productivity to be preserved across time. Work done today can be saved and used tomorrow, next month, or next year. This ability to store value is essential for planning, saving, and investing. It allows individuals and societies to build resources over time. The financial system supports these functions through multiple layers of structure. Banks hold deposits and facilitate payments. Central banks manage the supply of money and oversee the banking system. Payment networks connect institutions and enable transfers. Regulatory frameworks establish rules and ensure compliance. Each layer plays a role in maintaining the overall function of the system. The system also provides mechanisms for credit and lending. This function is distinct from simply storing and transferring existing value. Credit allows value to be created in the present based on expected future value. It enables investments that would otherwise be impossible. It allows individuals to purchase homes, businesses to expand, and governments to fund projects. Trust is the foundation upon which the entire system rests. Money has value because people believe it has value. Institutions function because people trust them to function. Transactions occur because both parties believe the system will honor the exchange. This trust is not arbitrary. It is built through consistency, reliability, and the presence of safeguards that protect participants. The system is designed to be stable and resilient. Stability ensures that money retains its value over time. Resilience ensures that the system can absorb shocks and continue functioning even when stressed. Both qualities are maintained through careful management, regulation, and continuous monitoring. Different countries have different financial systems, but they share common elements. Each system includes institutions that hold and transfer money. Each has mechanisms for regulating and overseeing these institutions. Each has ways of creating and controlling the money supply. The specific structures vary, but the underlying purposes remain consistent. The financial system is not static. It evolves in response to changing needs, new technologies, and emerging challenges. What worked in one era may be insufficient in another. The system adapts, incorporating new tools and methods while maintaining its core functions. Understanding the financial system means recognizing that it is both simple and complex. The basic purpose is straightforward: to enable economic exchange. But achieving this purpose requires coordination across countless participants, adherence to agreed-upon rules, and continuous adjustment to changing conditions. The simplicity of its goal coexists with the complexity of its implementation. The system exists because individuals and societies need it. It emerged from necessity and has been refined over time. It is maintained not by any single authority, but by the collective actions of everyone who participates in it. Each transaction, each deposit, each payment is an act of participation in this larger system. Money, as it exists in modern financial system, is created through processes that are often misunderstood. The creation of money is not a simple matter of printing currency. Most money exists not as physical objects, but as records in electronic systems. These records are created through specific mechanisms that are central to how the financial system operates. Central banks play a primary role in the creation of base money. Base money includes physical currency and the reserves that banks hold at the central bank. When a central bank creates money, it does so by crediting accounts or by purchasing assets. This newly created money enters the system and becomes available for use by banks and other financial institutions. Commercial banks also create money, though in a different way. When a bank makes a loan, it creates a deposit in the borrower's account. This deposit is new money that did not exist before the loan was made. The borrower can now use this money to make purchases or payments. The money is created through the act of lending. This process may seem unusual at first. It differs from the common understanding that banks lend out money that has been deposited with them. In reality, banks create deposits when they lend. The loan and the deposit come into existence simultaneously. The bank records an asset, which is the loan, and a liability, which is the deposit. Both sides of the balance sheet increase at the same moment. The ability of banks to create money is constrained by regulations and practical limits. Banks must hold a certain amount of reserves relative to their deposits. They must maintain sufficient capital to absorb potential losses. They must manage their liquidity to ensure they can meet withdrawal requests. These constraints prevent unlimited money creation and help maintain stability. The process of money creation is connected to the broader economy. When banks lend, they increase the money supply. When loans are repaid, the money supply contracts. The flow of lending and repayment continuously adjusts the amount of money in circulation. This dynamic process responds to demand for credit and to the willingness of banks to lend. Central banks influence this process through their policy. By adjusting interest rates, they affect the cost of borrowing. By setting reserve requirements, they influence how much banks can lend. By buying or selling assets, they add or remove base money from the system. These tools allow central banks to guide the overall level of money creation. The creation of money is not unlimited or arbitrary. It is constrained by economic reality. Banks lend when they expect to be repaid. Borrowers take loans when they believe the benefits exceed the costs. The process is self-regulating to a degree, expanding when conditions are favorable and contracting when they are not. Physical currency represents only a small fraction of the total money supply. Most money exists as electronic records in banking systems. When someone checks their account balance, they are viewing a number that represents their claim on the banking system. This number can be transferred, divided, and combined without any physical movement of objects. The formation of the financial system itself occurred gradually over centuries. Early societies used commodity money, where the money itself had intrinsic value. Gold, silver, and other precious metals served this purpose. Over time, paper currency emerged, representing a claim on precious metals held by a bank or government. Eventually, the link to commodities was severed. Modern money is fiat money, meaning it has value by decree rather than by intrinsic worth. This transition allowed for greater flexibility in managing the money supply. It also placed greater responsibility on institutions to maintain the value and stability of the currency. The formation of central banking institutions was a crucial development. Central banks emerged to address recurring financial crises and to provide stability to the banking system. They became lenders of last resort, able to provide liquidity to banks facing temporary difficulties. This role helped prevent bank failures from cascading through the system. Payment systems developed to enable money to move efficiently. Initially, payments were settled through physical delivery of currency or precious metals. As trade expanded and distances grew, this became impractical. Banking networks emerged to facilitate transfers without physical movement. Over time, these networks became increasingly sophisticated and interconnected. The rules and regulations that govern the financial system were also formed gradually. Each financial crisis or failure prompted new safeguards. Each technological advance required new frameworks. The accumulation of these rules created the regulatory structure that exists today. This structure aims to balance enabling financial activity with protecting stability. The formation of the system continues even now. New technologies introduce new possibilities and new challenges. Digital currencies, mobile payments, and other innovations are being integrated into the existing framework. The system adapts, incorporating what is useful while maintaining its core functions. Understanding how money is created helps clarify how the system operates. Money is not a fixed quantity, but a dynamic variable that expands and contracts based on lending activity. This flexibility allows the system to respond to changing economic conditions. It also creates responsibility for those who manage the process. Each day, the financial system processes millions of transactions. Payments are made for goods and services. Deposits are recorded. Withdrawals are processed. Money moves from one account to another, from one institution to another, from one country to another. This constant flow of activity is the system functioning as designed. When someone makes a payment, several steps occur behind the scenes. The payer's account is debited. The payee's account is credited. The banks involved adjust their records accordingly. If the accounts are at different banks, the banks must settle the payment between themselves. This settlement occurs through interbank payment systems. Interbank payment systems are networks that connect banks and allow them to transfer funds. These systems track obligations between institutions and facilitate final settlement. Settlement may occur at the end of each day or in real time, depending on the system. The process ensures that all parties' records remain consistent and accurate. Central banks often operate key payment systems or oversee their operation. This provides a neutral and trusted infrastructure for interbank transfers. Banks hold accounts at the central bank, and these accounts are used to settle payments. When Bank A owes Bank B money, the central bank debits Bank A's account and credits Bank B's account. This central settlement mechanism is fundamental to the system's operation. For individuals and businesses, Payments have become increasingly convenient. Cards, mobile apps, and online platforms allow transactions to occur instantly. Behind this convenience lies the same underlying infrastructure. Each transaction follows a path through the system, involving multiple participants and multiple steps, even though the user experiences it as immediate. The system also manages the supply of physical currency. Central banks produce and distribute currency to commercial banks. Commercial banks distribute it to businesses and individuals through ATMs and branch withdrawals. Currency that is worn or damaged is returned to the central bank and destroyed. New currency is produced to replace it. This cycle maintains an adequate supply of physical money. Deposits are a central feature of daily operation. When someone deposits money into their account, the bank records a liability to that person and an asset in the form of reserves or loans. The deposit can be withdrawn at any time, but in practice, most deposits remain in the system. This stability allows banks to use deposits as a funding source for lending. Lending occurs continuously throughout the system. Banks evaluate loan applications, assess creditworthiness, and decide whether to extend credit. When a loan is approved, new money is created as described earlier. The borrower receives the funds and begins making payments according to the agreed-upon schedule. These payments gradually reduce the loan balance and the associated deposit. Interest plays a role in both deposits and loans. Depositors may receive interest on their balances, compensating them for allowing the bank to use their funds. Borrowers pay interest on their loans, compensating the bank for the risk and the service of providing credit. The difference between these rates is a primary source of bank revenue. Risk management is an ongoing activity. Banks monitor their exposure to various risks, including credit risk, interest rate risk, and liquidity risk. They maintain capital buffers to absorb losses. They diversify their lending to avoid concentration. They test their systems and processes to ensure resilience. These practices are essential for maintaining stability. Regulatory oversight is continuous. Regulators examine banks' records, practices, and financial condition. They ensure compliance with laws and regulation. They assess whether banks are managing risks appropriately. When deficiencies are found, corrective actions are required. This oversight helps prevent problems from developing into crises. Information flows constantly through the system. Account balances are updated. Transaction records are created and stored. Reports are generated for internal management and external regulators. This information is essential for decision-making and for maintaining trust. Accuracy and security are paramount. Foreign exchange is another daily function. When transactions cross borders, currencies must be exchanged. Foreign exchange markets facilitate these conversions. Rates fluctuate based on supply and demand, economic conditions, and policy decisions. The system accommodates these exchanges seamlessly, allowing international commerce to proceed. The day-to-day functioning of the financial system is largely invisible to most users. Transactions occur smoothly. Money is available when needed. The system operates in the background, enabling economic activity without drawing attention to itself. This invisibility is a sign of success. The system is designed to be unobtrusive, to facilitate rather than to obstruct. Maintenance and upgrades occur continuously. Technology systems are updated. Security measures are enhanced. New services are introduced. Old systems are retired. The system evolves while continuing to operate, much like a building that is renovated while people still work inside it. Coordination across institutions is essential. No single bank or entity controls the entire system. Each participant must follow agreed-upon standards and protocols. This coordination allows the system to function as a whole, even though it is composed of independent parts. The result is a network that is robust and flexible. The financial system does not operate in isolation. It is deeply connected to other systems and structures within society. These connections create a web of relationships that influence how money moves, how value is created, and how economic activity is organized. Banks are the most visible participants in the financial system. They accept deposits, make loans, and facilitate payments. But banks also interact with central banks, regulatory agencies, payment processors, and each other. Each interaction involves protocols, agreements, and shared infrastructure. Banks rely on these connections to function. Central banks occupy a unique position within the system. They issue currency, manage monetary policy, and oversee financial stability. They serve as banks for commercial banks, holding their reserves and facilitating settlement between them. Central banks also interact with governments, providing banking services and sometimes financing government operation. The relationship between central banks and governments is important but varies by country. In some systems, the central bank is highly independent. In others, it operates more closely with government direction. Regardless of the specific arrangement, central banks and governments must coordinate on matters of fiscal and monetary policy. These policies affect the entire economy. Businesses interact with the financial system through multiple channels. They maintain bank accounts to receive payments and pay expenses. They borrow to finance operations and investments. They use financial services to manage currency risk, process payroll, and handle international transactions. The financial system enables businesses to operate efficiently across markets and borders. Individuals also interact continuously with the system. They hold deposits, make payments, borrow for homes and education, and save for the future. These activities are personal and immediate, yet they connect each individual to the broader infrastructure. The system serves individuals by providing access to services that would be impossible to arrange independently. Financial markets are another key component of the broader ecosystem. Stock markets, bond markets, and other trading venues allow assets to be bought and sold. These markets provide mechanisms for price discovery and for transferring risk. They also interact closely with the banking system, as banks often facilitate trading and provide credit to market participants. Insurance companies and pension funds are major participants in financial markets. They collect premiums or contributions and invest those funds to meet future obligations. Their investment activities provide capital to businesses and governments. Their presence adds depth and stability to markets. They also interact with banks for custody, payment, and other services. Payment systems connect all these participants. Credit card networks process consumer transactions. Wire transfer systems handle large payments between institutions. Automated clearinghouses batch and settle routine payments like payroll and bill payments. Each system has its own rules and infrastructure, but all are interconnected through the broader financial network. Technology infrastructure underlies every interaction. Data centers store records. Communication networks transmit information. Software systems process transactions and manage accounts. Security systems protect against fraud and unauthorized access. This technological layer is essential for the system's operation and continues to evolve rapidly. Regulatory agencies interact with all parts of the financial system. They set rules, monitor compliance, and intervene when necessary. Different agencies may oversee different parts of the system: banks, securities markets, insurance companies, and so on. Their goal is to maintain stability, protect consumers, and ensure fair practices. International connections are extensive. Money flows across borders through trade, investment, and lending. Banks operate in multiple countries. Payment systems span continents. International organizations coordinate standards and facilitate cooperation among national authorities. This global network allows the financial system to operate on a worldwide scale. The interaction between the financial system and the real economy is continuous. Financial institutions provide credit that allows businesses to invest and expand. They facilitate payments that enable commerce. They offer savings vehicles that allow individuals to prepare for the future. In return, the real economy generates the income, profits, and growth that sustain the financial system. Trust institutions also play a role. Legal systems enforce contracts and property rights. Accounting standards provide consistent methods for measuring financial condition. Rating agencies assess credit quality. Auditors verify financial statements. These supporting institutions enhance trust and transparency throughout the system. Government debt markets are particularly important. Governments issue bonds to finance their operation. Financial institutions purchase these bonds as investments. Central banks may also buy government bonds as part of monetary policy operations. These markets link government finance, monetary policy, and private investment. The housing market illustrates how systems interact. Individuals borrow from banks to purchase homes. Banks may sell these mortgages to investors or hold them on their balance sheets. Housing prices affect household wealth and spending. Policies regarding interest rates and credit availability influence housing demand. The financial system, the housing market, and the broader economy are deeply interconnected. When the financial system interacts with other systems, it both influences and is influenced by them. Financial conditions affect economic activity. Economic activity affects financial conditions. This circular relationship creates feedback loops that can amplify both growth and contraction. Understanding these interactions helps explain why financial stability is so important. The interconnections also mean that problems in one area can spread to others. A bank's difficulties can affect its customers and counterparties. Market disruptions can impair banks' ability to fund themselves. Economic downturns can increase loan defaults. The system is resilient but not impervious. Managing these connections is a central challenge for policymakers and institutions. The financial system, like any complex system, can experience stress. Stress arises when normal functioning is disrupted or when participants lose confidence. How the system responds to stress determines whether stability is maintained or whether problems escalate. Bank failures represent one form of stress. A bank fails when it cannot meet its obligations to depositors and creditors. This may occur due to large loan losses, poor management, or sudden withdrawals. When a bank fails, mechanisms exist to limit the damage to the broader system. Deposit insurance is one such mechanism. It protects depositors by guaranteeing their deposits up to a certain amount. This protection reduces the incentive for depositors to withdraw their funds during times of uncertainty. By preventing panic withdrawals, deposit insurance helps contain problems to individual institutions. Regulators have tools to intervene when banks face difficulties. They can require additional capital, restrict certain activities, or facilitate mergers with stronger institutions. In extreme cases, they can close a failing bank and transfer its deposits and assets to another bank. These interventions aim to resolve problems while minimizing disruption. The concept of systemic risk refers to threats that affect the system as a whole. An individual bank's failure is usually manageable. But when many institutions face problems simultaneously, or when a very large institution fails, the consequences can spread. Systemic risk is the concern that motivates much of financial regulation. Central banks serve as lenders of last resort. This means they can provide emergency funding to banks that are solvent, but facing temporary liquidity problems. By doing so, they prevent solvent banks from failing due to short-term funding difficulties. This function is critical during periods of financial stress. Financial crises represent severe forms of systemic stress. During a crisis, credit becomes scarce, asset prices fall, and confidence erodes. The system tightens, making it harder for businesses and individuals to access funds. Economic activity slows as a result. Crises can be triggered by many factors: asset bubbles, excessive debt, sudden shocks, or loss of confidence. The response to financial crises typically involves multiple tools. Central banks may lower interest rates to encourage borrowing and spending. They may provide liquidity directly to markets and institutions. Governments may guarantee debts or inject capital into failing institutions. Regulatory standards may be temporarily adjusted. The goal is to stabilize the system and restore confidence. Stress tests are used to assess resilience before crises occur. Regulators simulate adverse scenarios and evaluate how banks would perform. These tests identify vulnerabilities and require institutions to strengthen their positions if needed. The process enhances preparedness and builds buffers against future stress. Capital requirements are designed to ensure banks can absorb losses. Banks must hold a minimum amount of capital relative to their assets. This capital serves as a cushion, protecting depositors and the system if loans default or assets lose value. Higher capital requirements increase resilience, but may reduce profitability. Liquidity requirements ensure banks can meet short-term obligations. Banks must hold sufficient liquid assets that can be quickly converted to cash. This prevents situations where a bank has valuable assets but cannot meet immediate payment demands. Liquidity management is distinct from but complementary to capital management. Interconnectedness creates both strength and vulnerability. When institutions are connected, they can share risk and provide mutual support. But connections also create channels through which problems can spread. A failure in one institution can quickly affect its counterparties, who may then affect others. Managing interconnectedness is a key challenge for regulators. Market disruptions can occur suddenly. Prices may change rapidly due to new information or shifts in sentiment. Trading may become difficult if buyers and sellers cannot agree on prices. In extreme cases, markets may cease to function temporarily. The financial system must be able to withstand these disruptions without failing. Confidence is perhaps the most important factor in maintaining stability. When participants trust the system, they continue to deposit, lend, and transact. When confidence erodes, the system can unravel quickly. Maintaining confidence requires not only sound practices, but also effective communication and visible safeguards. The system includes automatic stabilizers that respond to stress. Deposit insurance activates when needed. Central bank lending facilities stand ready to provide liquidity. Regulatory interventions occur when problems are detected. These mechanisms do not prevent all problems, but they reduce their severity and duration. Recovery from stress involves rebuilding trust and repairing damage. Institutions that survived must strengthen their position. Those that failed must be resolved without further disruption. Credit flows must be restored so economic activity can resume. This process takes time, but is essential for returning to normal functioning. The balance between stability and efficiency is ongoing. Too much regulation can stifle financial innovation and economic growth. Too little regulation can allow excessive risk-taking and instability. Finding the right balance requires constant adjustment as conditions change. Stress is inevitable in any system that serves a dynamic economy. What matters is how the system responds. Resilience, not the absence of problems, is the goal. The financial system is designed with this understanding. Safeguards exist not because failure is certain, but because it is possible. Preparation reduces impact. We have explored the financial system from multiple perspectives. Now we will revisit these concepts gently, allowing them to settle more deeply. Money moves through interconnected institutions and systems. Each transaction is a moment within a larger flow. The flow continues day and night, enabling exchange, preserving value, and coordinating activity across vast distances. The system exists because societies need ways to organize economic life. Without shared tools for exchange, modern economies would be impossible. The financial system provides those tools. It creates the infrastructure that allows individuals, businesses, and governments to interact economically. Trust underlies everything. Money has value because it is trusted. Institutions function because they are trusted. The entire system operates on the foundation of shared belief and confidence. This trust is earned through consistency, transparency, and the presence of safeguards. Banks accept deposits and make loans. In doing so, they create money and facilitate its movement. They serve as intermediaries, connecting those who have resources with those who need them. This intermediation is central to how the system functions. Central banks guide and stabilize. They manage the money supply, oversee financial institutions, and act when crises threaten. Their role is to maintain conditions that allow the system to function smoothly. They do not control every detail, but influence the overall environment. Payment systems link all participants. Every transaction travels through networks that connect accounts, banks, and institutions. These networks operate continuously, processing millions of payments and ensuring records remain accurate. The infrastructure is complex, but largely invisible to users. Money is created through lending. When a bank makes a loan, new deposits come into existence. When loans are repaid, deposits disappear. This cycle expands and contracts the money supply in response to economic needs and credit conditions. The process is not unlimited. Constraints exist in the form of capital requirements, reserve requirements, and practical considerations about risk. These constraints ensure that money creation remains tied to economic reality. They prevent excess and maintain balance. Stability requires preparation. The system includes buffers that absorb shocks. Capital cushions losses. Liquidity meets payment demands. Insurance protects depositors. Emergency lending provides support when needed. These features make the system resilient. Stress will occur from time to time. Banks may face difficulties. Markets may become volatile. Confidence may waver. The system is designed to withstand these pressures through a combination of internal strength and external support. Regulation and oversight provide ongoing monitoring. Standards are set and enforced. Practices are examined. Problems are identified and addressed early when possible. This continuous attention helps prevent small issues from becoming large crises. The system connects to the broader economy in countless ways. It finances business investment. It enables consumer spending. It facilitates trade across borders. Economic activity depends on financial services, and financial services depend on economic activity. Technology enables much of what the system does. Electronic records replace physical ledgers. Digital networks transmit information instantly. Automated systems process transactions without human intervention. This technology makes the system faster and more efficient while maintaining accuracy. Physical currency remains, but represents a small portion of money. Most money exists as numbers in computer systems. These numbers represent claims and obligations. They can be transferred and combined without ever taking physical form. The abstraction does not diminish their reality or their utility. International connections extend the system globally. Money crosses borders through trade and investment. Banks operate in multiple countries. Currencies are exchanged in vast markets. The system accommodates these flows, creating a financial network that spans the world. When someone makes a simple payment, the system processes it through multiple steps. Records are updated. Balances change. Institutions settle among themselves. All of this happens quickly and quietly. The user experiences simplicity. The system manages complexity. Deposits are safe because of multiple protections. Banks maintain capital to absorb losses. Insurance covers most deposits. Regulators monitor bank health. Central banks stand ready to provide liquidity. These layers of protection work together to maintain stability. Lending creates opportunities. Individuals can buy homes before saving the full price. Businesses can invest in growth before accumulating sufficient profits. Governments can fund projects that will deliver benefits over many years. Credit makes these possibilities real. Risk is inherent in lending. Borrowers may fail to repay. Economic conditions may deteriorate. Unexpected events may disrupt plans. The system manages risk through diversification, underwriting, and capital buffers. Risk cannot be eliminated, but it can be managed. Interest rates reflect many factors. They compensate lenders for risk and for the time value of money. They respond to supply and demand for credit. They are influenced by central bank policies. Rates vary across different types of loans and different borrowers. The flow of money through the system creates patterns. Some money circulates rapidly, changing hands frequently. Other money remains in long-term savings or investments. The velocity of money, its speed of circulation, affects economic activity. The system accommodates both stability and movement. Financial markets provide additional channels for moving resources. They allow savers to invest in businesses and governments. They enable risk to be transferred and prices to be discovered. Markets complement the banking system, providing alternative ways to allocate capital. Confidence can be fragile. It builds slowly through consistent performance. It can erode quickly when problems appear. Maintaining confidence requires not just sound practices, but also transparency and communication. When people understand the system, they are more likely to trust it. The system evolves continuously. New technologies are integrated. New regulations are implemented. New services are offered. Change occurs within a framework of continuity. The core functions remain constant, even as methods and tools improve. No single entity controls the entire system. It is decentralized, operating through the coordinated actions of many participants. Each follows agreed-upon rules and standards. Together, their actions create a functioning whole. The system is both organized and organic. When we pay for something, we participate in this vast network. When we deposit money, we engage with the infrastructure. When we borrow, we access the system's ability to create credit. These everyday actions connect us to something much larger. The invisibility of the system is intentional. It is designed to work quietly in the background. The better it functions, the less it is noticed. This is not a flaw but a feature. The system succeeds when it enables without obstructing. Understanding the financial system does not require mastering every detail. It requires recognizing the key elements: institutions that hold and transfer money, mechanisms that create and destroy money, networks that connect participants, safeguards that maintain stability, and policies that guide overall conditions. Each element serves a purpose. Institutions provide access and services. Mechanisms allow flexibility and responsiveness. Networks enable connectivity and efficiency. Safeguards protect against failures. Policies steer the system toward desired outcomes. The purposes are simple, even when the implementation is complex. The system exists to enable exchange, store value, and coordinate economic activity. Everything else follows from these basic needs. Complexity arises from scale, from diversity, and from the need to manage risk. Money is a social technology. It works because people agree that it works. This agreement is reinforced by institutions, by law, and by daily experience. The financial system supports and maintains this agreement, ensuring that money can reliably perform its functions. The system is not perfect. Problems occur. Mistakes are made. Crises happen. But the system also adapts and learns. Each crisis leads to reforms. Each failure prompts improvements. The system becomes more robust over time. Resilience is built through redundancy and diversity. Multiple institutions perform similar functions. Multiple channels exist for payments and transfer. Multiple safeguards protect against different types of failures. If one path is blocked, others remain available. The financial system reflects the societies it serves. Different countries have different structures based on their histories, values, and needs. But all financial systems share common purposes and face common challenges. The variations in design reflect different approaches to solving similar problems. Stability and growth are both important. A stable system provides confidence and security. A growing system provides opportunities and progress. Balancing these objectives requires judgment and adaptation. Too much emphasis on stability can stifle growth. Too much emphasis on growth can undermine stability. The people who work within the system play essential roles. Bankers, regulators, Central bankers, technology specialists, and many others contribute to its functioning. Their decisions, expertise, and actions collectively determine how well the system performs. The human element remains crucial despite increasing automation. Transparency supports trust. When institutions disclose their condition and practices, outsiders can assess their soundness. When regulations are clear and consistently applied, participants know what to expect. Transparency does not mean revealing everything, but rather providing sufficient information for informed decisions. The system serves multiple purposes simultaneously. It facilitates everyday transactions while also supporting long-term investments. It enables individual savings while also funding large projects. It operates locally while also connecting globally. This multiplicity of functions makes the system valuable and complex. Credit is creation. It brings future value into the present. It allows plans to be executed before resources have been accumulated. This ability to work with future value is one of the system's most powerful features. It is also one that requires careful management. The relationship between money and goods is fundamental. Money represents a claim on real resources. If money grows faster than real resources, its value diminishes. If money grows slower, its value increases. Managing this relationship is a central task of monetary policy. Information flows are as important as money flows. Account balances, transaction histories, credit scores, and financial statements all convey essential information. This information guides decisions about lending, investing, and managing risk. Accuracy and security of information are vital. The system is both rigid and flexible. Rules and standards provide structure and predictability. Within that structure, participants have freedom to innovate and adapt. This combination allows the system to be reliable while also being responsive to change. Time is embedded in the system. Loans have terms. Deposits earn interest over time. Investments mature at specified dates. The system coordinates activity not just across space, but also across time. It links present actions to future outcomes. The hidden nature of the system is both strength and challenge. When it works well, people can focus on their activities without worrying about financial infrastructure. When problems arise, the complexity can make them difficult to understand and address. Education and transparency help bridge this gap. Every transaction is both an individual act and a systemic event. When someone buys something, they personally acquire goods or services. Systemically, they also participate in the flow of money that sustains economic activity. Individual actions aggregate into system-level patterns. The financial system is a human creation. It did not emerge from nature, but was designed and built to serve human needs. As needs change, the system changes. As technology advances, the system incorporates new capabilities. It is continuously shaped by the people who use it and manage it. In quiet moments, the system continues its work. Money flows. Records update. Institutions balance their books. The work is constant but largely invisible. This continuity is what makes modern economic life possible. Understanding comes gradually. Each concept builds on previous ones. Each perspective adds depth to the overall picture. The system is too large to grasp all at once. But piece by piece, its logic and structure become clear. The financial system is infrastructure. Like roads, bridges, and communication networks, it enables activity rather than being the activity itself. Its value lies in what it makes possible. When infrastructure works well, it fades into the background, noticed only when absent or impaired. We have journeyed through the layers of this system, from daily transactions to systemic stability, from money creation to international connections. The picture is now more complete. The system is intricate yet purposeful, complex yet comprehensible. What we have explored tonight is both practical and abstract. Practical because it affects every economic decision. Abstract because much of it exists as agreements, records, and shared understanding rather than physical objects. Both dimensions are real and important. The system will continue to evolve. Future developments will bring changes we cannot fully predict. But the core purposes will remain: to enable exchange, to store value, and to coordinate economic activity. These purposes are fundamental to organized societies. As we conclude this exploration, the essential points rest gently. Money moves through systems designed for that purpose. Those systems are maintained by institutions, guided by policies, and protected by safeguards. Trust and confidence underpin everything. Understanding brings clarity without requiring mastery of every detail. The hidden ways money really works are now less hidden. The system that seemed complex has revealed its logic. The processes that appeared mysterious now make sense. This understanding is quiet knowledge, available whenever needed. The financial system continues its work. Tomorrow, the same flows will occur. The same institutions will operate. The same purposes will be served. The system persists, enabling the economic lives of billions. And with that understanding, we rest,